Okay, so once again, thank you for joining us for today's webinar. So as Ethan has mentioned, today's webinar is really more of education purposes rather from what's happening in the market, what's the outlook. Because for that we actually have our weekly market scoop. If you are not aware, we actually have this session every Tuesday, 5 p.m. to around 5:30, 5:40 p.m. where I'll just share the fresh market updates every week, and also some of the trade ideas that you're looking at. Because I understand that many of you are busy with your own work. Trading is just a sideline for you. So do tune in to this weekly market scoop every Tuesday. So that is where you can get all of your market updates. But for today's webinar, is for those that really want to understand how to actually do how to have a very simple system to analyze in terms of the fundamental aspect, the technical aspect, the sentiments aspect for various asset class. So today I'll go through a few asset class, namely indices. I'll go through Forex. I'll go through the common gold and also Brent crude oil, your oil prices. So without further ado, let's just dive straight in. And just to highlight again, it's an educational webinar. So it doesn't constitute any investment advice. Whether any buy or sell that is mentioned, please do your own due diligence and do your own discretion for your trading or investment journey. Okay, this is me. I think Ethan has given a very good overview of who I am. Just two things that I want to bring your attention to. One will be the Twitter account. You can follow at ip_IG. The second one, I guess, is the more popular options, especially among the local clients, is the Telegram group. Our Telegram group is IG Asia. So it's totally free. I mean, if you join, you'll be able to gain access to market analysis from our analysts across the globe. And then we will push out, content to you on a daily basis. So just want to share these two social avenue that we have that may be of interest to you. Okay, so let's move straight into our very first topic for today. So I will be touching on indices. So for those that are just starting out, why indices is basically your stock index. So some people refer to it as a basket of stocks. So a local one will be the Straits Times Index. The top 30 companies in the Singapore market is under this Straits Times Index. In the US, the more common one will be the S&P 500, the Nasdaq Composite, Nasdaq 100, the Dow Jones Industrial Average, or even the Russell 2000. So those are indices. So you can think of it as a basket of stocks. So when we look at indices, generally when people analyze indices, just to share my personal take, is that there's always a fundamental component to it. That is where your economic factors came in. There's a technical aspect to it. That is where you look at the charts. That is where you look at the trend line. You look at the technical indicators. And last but not least, I think it's also very important is the sentiments, how investors are actually positioned. So this will tell you whether a trade is being overcrowded, because you will not want to join in an overcrowded trade, because that raises the risk of a potential retracement, a potential pullback in that sense. You wouldn't want to be caught in that. So later I'll show you, I think recently the US indices have given a very good example of where a trade is sort of overcrowded, and then we are seeing some of a retracement. Later I'll give you a very good example on this. But usually when people talk about indices, it's always, fundamental analysis, technical analysis, but they very often miss out these sentiments and also what to actually look out for. So in this webinar, I'll share with you. But let's delve into the more common one, the fundamental factors that many of us are familiar with. So what is these fundamental factors? Is namely what you see on the news headline on the economy. Many of you will be familiar with the GDP growth, the inflation, the unemployment rate, the interest rate outlook. Okay, so just to highlight that when we look at fundamental factors, my personal take is that looking at one factor can actually have a multiple outcome. So just to give you an example, okay, if you look at the robust labor market, if labor market is very strong, if you were to put it under a deflationary environment, it could be a positive thing. Okay, but recently we know that we are in this very high inflationary environment, and whenever we talk about robust labor market, it just means that the Fed has to do more, has to tighten even further. So that brings a negative connotation to it. So looking at this simple factor of, a very robust labor market, but if you were to place it on a different inflation environment, it can actually yield different results. So for now, it does seem that, when inflation is too high, the Fed clearly are very uncomfortable with seeing unemployment rate so low. They actually want to see the labor market cool down a little bit. And if you have this robust labor reading coming out in your non-farm payroll, initial jobless claims, it just means the Fed has to do more, and you wouldn't want to go against the Fed. So that's the general narrative. You wouldn't want to go against the Fed. So another example is inflation in a rising interest rate regime. We know that inflation, we can have disinflation, we can even have a taxation scenario. And of course, if we look at PMI readings, it is always compared to market expectations. So some people may ask, the PMI reading is not very good, but how come the markets can rally? Or not just in terms of PMI reading, some other economic indicator, the question will always surface. I mean, the industrial production is not perfect. Why does the markets can actually rally on that? So it boils down to what markets are actually pricing for, what is their expectations for the reading heading into the data release. So for example, if they are looking for a PMI reading of maybe 52, and the PMI reading came out as 54, for example, so it's actually higher than expected, and markets deem that as, economy is stronger than what they initially deemed. So that is a positive thing. But on the other hand, if markets are expecting, PMI reading to come in at 58, for example, the post COVID boom, where we are seeing a very strong surge in demand, we are seeing very strong reopening, propelling the economic conditions. That's why people are expecting PMI reading to come in at 58. And in that sense, if your PMI reading came in at 54, people may deem that, actually, are we being too optimistic with regards to all of these COVID reopening efforts? Whether the economic rebound, are we being actually too optimistic in that? So same thing again, you can have a single reading of 54 in a PMI reading, but based on different expectations, you can have multiple outcomes. So just this key thing is really not to take a single data as, as an absolute face value. You have to compare with a lot of things. You have to compare with the other factors in the economic environment. You have to look at the market expectations as well. Okay, next thing, I think more popular one, it will be the US Treasury yields versus equity market movement. So recently, when the whole narrative is about the Fed's tightening effort, when US Treasury yield rise, the equity market tends to fall. So this is what has been sort of happening over the past 2 years, an inverse relationship between US Treasury yield versus equity markets. But if you were to expand the timeline, go back in time towards the COVID-19 period, where there is sort of a widespread kind of a panic, you will realize that when US Treasury yields sort of rise, the equity markets, when US Treasury yields fall, the equity markets also fall. So there was actually a positive correlation in that sense, because markets are seeing this widespread panic. And when panic mode kicks in, people prefer to hold cash. So that is what is happening in the COVID-19 period. So in a way, the relationship can break down. It doesn't work 100% of the time. And these are just some examples to say that, when you look at a data from its absolute value, it doesn't really mean much. You have to really compare it to the other, like what is the market theme that we are trending in, and also what is the market expecting. So for now, we are just to bring it back to the current market conditions. We know that inflation is a problem. So we are in an inflationary environment. So robust labor market, not well received. I mean, the Fed wants to bring it down. We want to see inflation coming down. And when we look at strong PMI readings, people are having chatters of whether we will have a soft landing or a hard landing. So 1 year back, when we talk about very strong PMI reading in this inflationary environment, people tend to worry, because if you have very strong PMI reading, it just means that the Fed has to tighten more. But fast forward to today, if we look at a strong PMI reading, markets tend to like that. Why? Because markets are saying that, yes, I think the Fed is heading towards this final stage of tightening. If we have a very strong PMI reading, that adds to the soft landing camp. So same thing again, when we talk about different economic data, you have to look at what is the current situation, what is the key market theme that markets are looking at. Okay, so some other fundamental and economic factors, just to share with you, when we look at, for example, the Singapore economy, we are very sensitive to external demand. We are very dependent on exports. We are a very open economy. So in a sense, we look a lot at our export figure. So where our exports see a huge contraction, like recently, we have seen a huge contraction in industrial production, in non-oil domestic export. It suggests that our economy is facing headwind. But on the other hand, if we were to look at the US economy, they are very consumption-based. Consumer spending takes up around 60 to 70% of their economic growth. So from that perspective, we have to shift our focus towards retail sales data. And just to share with you the relationship between the UOM Consumer Sentiment Index from the left and the S&P 500 on the right. This is just really to show you how some of these consumer-related indicators have quite a profound impact on the S&P 500. So over the past historical instances, whenever the consumer sentiment see a bottom, as shown on the circle, the red circle on the chart on the left, it tends to coincide with some of the near-term bottoms for the S&P as well. So recently, I think it has also played out well. I think this chart is not updated, but recently it has also played out well, where we are seeing somewhat of a more resilient consumer consumption picture, and the S&P 500 kind of form a near-term bottom. So if you want to look at some of the, where the S&P is kind of headed, some of the consumer-related indicators will definitely be on your radar. Whereas on the Singapore side of things, you got to look at industrial production, you got to look at export figures to determine how the markets will move. Okay, next thing, if you look at the S&P 500, likewise, manufacturing PMI could have some impact. I wouldn't say it is a full determinant because, as I mentioned, the US is very consumption-based. But why manufacturing PMI has such quite a general correlation with the S&P 500 performance is that even though the whole economy is consumption-based, more consumption-based, if you look at the breakdown of the companies in the S&P 500, half of them is actually exposed to manufacturing, the sector itself. So there is some kind of misalignment between the overall economy and the composition in the S&P 500. But nevertheless, all of this boils down to how the economic conditions are playing out, whether we are seeing a very strong growth in that sense. Because if you are seeing strong growth, it means that corporate profits may increase And we know that S&P 500 is a function of corporate profits, so the S&P 500 may increase as well. Okay, this is just to show you the correlation. When economic conditions are strong, company profits, the earnings per share increase. It tends to guide the S&P 500 upwards. But the catch is for this is that the index is always forward-looking. So the stock market is always forward-looking. Generally, it will react first before you see the data come out. So that is why, you know, when we look at fundamental factors, I mean, we can run prediction, we can try to time. Sometimes it is just there's some restrictions in place because sometimes the markets are already reacting first, because many of the funds they have more real-time proprietary data. They have an edge over us in monitoring how the economic conditions are moving forward, and sometimes we do lose out in that sense. So other than looking at, you know, many of these fundamental factors, that is why we also have to depend on the technical side of things and also the sentiment side of things. So just to share one last on fundamentals factors, I think I largely look at the US coincident index and the US leading index. So what is the difference between these two? Okay, so the US coincident index measure the state of the current economic conditions, whereas the US leading index kind of show you what is the economic conditions in the future, maybe 1 year out. So it's more forward-looking in that sense. So this is a more updated kind of a chart. You can see that the current conditions are still strong, as seen from the red line. But if we were to zoom to the blue line, you will see that it has actually been moderating quite quickly, or even to levels of a past recession, as you can see from you know, across the time frame. We are actually reaching the levels where we saw previous recession taking place. So looking at this, what does it tell you is that yes, current conditions are still strong. Economic conditions may continue to surprise to the upside, continue to ride the wave, ride the trend, but do keep a lookout because there seems to be headwinds still lingering, as you know, lingering over the months ahead. So that is why we are still taking on a more cautious stance. There is, I will say, there is a wall of worry to climb in terms of the US indices over the coming months. So this is how you actually use all of these data to try to form sort of an opinion of where things are headed. Of course, in another hypothetical scenario, when we see current conditions are still strong and that blue line is kind of outward sloping, we are looking at a stronger growth ahead, like that seen in the COVID-19 period, seen in the aftermath of the 2008 crisis, then yes, that kind of reinforced the view that economic conditions may continue to be strong a few months out, so that extend your runway in, you know, being invested in US equities. But for now, it seems like a different story. Now still strong, but continue to have headwinds ahead, so that will keep you more on a cautious positioning. You know, do not overexpose to too much on equities. Yeah. Okay, so next thing will be I will use this to explain how the current conditions, the current readings are actually compared with expectations. So you can look this up. It's called the Economic Surprise Index. They actually have one for the US, they have one for China. So it kind of measure how economic data are coming in as compared to market expectation. So of course, if you hope that the US indices can continue to climb further, that is where you want to see a positive economic surprise. But on the other hand, if you were to see a negative economic surprise, it means that the current economic data are coming in below expectations, and this wouldn't be what you want if you are if you are holding a long position. Okay, so with that fundamental side of things out of the picture, I think the key takeaway is really I'll share some of the data, how you actually use all of this data to form an opinion of where the economic state is going, the current state, and of course the future state as well. And then next, to reinforce your trading decision, then you turn to the technical side of things. So when we look at technicals, I believe, some people look just at, the daily chart, or some people just look at the 4-hour chart. Some people or even look at, the 1-hour chart, go in for the short trades, that kind of thing. But generally, when we look at technical side of things, I think to reduce your risk and to increase the chances of you profiting, the longer term trend and the shorter term trend must align. So what I mean by this is that the longer term trend in my case is the weekly chart. I must make sure that the weekly chart is pointing towards an upward bias trend. Thereafter, I zoom in into the daily chart, and I have to make sure that the daily chart is also on its upward bias trend. So you have that longer term trend on the upside, the shorter term trend on the outside. There is somewhat of an alignment, and that kind of increase your conviction of going into a long position. Because if you have the longer term trend on the downside and then the daily chart showing on the upside, it's kind of a conflicting. And then when you jump in, I think the risk is significantly higher in that sense. So I want to see both trends sort of being aligned. Like in this case, I think this chart is updated. In this case, when you look at the weekly chart, okay, what I'm seeing here, I think is a upward bias trend. It actually broke above the Ichimoku cloud, if you're familiar with it. It's hanging above the cloud. It's hanging above its various moving average. The RSI above 50, good enough. MACD upward sloping, above 0, indicating positive momentum. So all of these kind of reinforce the view that the weekly side of things, upward bias. And if you look at the daily chart of things, for now, likewise, above moving average as well. Above is a cloud support. Near term wise, probably a bearish crossover on the MACD, on the RSI, so that increased somewhat the chance of a retracement. But nevertheless, as long as some of these support kind of holds, the overall upward trend is still intact, and you wouldn't actually really want to go against this trend. Okay, so in this case, weekly and daily sort of align. Of course, if you want to look at a monthly, 4-hour, it's really up to you. But the point is that, when you look at the chart, you have to make sure that multiple time frame kind of align with your view to sort of minimize the risk. Okay, last but not least, we talk about fundamental, we talk about technicals. One of the more overlooked one will be sentiments. Okay, like I shared, sometimes a trade can be overcrowded. So you wouldn't want to jump in front of an overcrowded trade, because you may be caught in a retracement when you could actually, jump in at a better position, at a better price. So some of the indicators for sentiments, the more commonly one, you may have heard of it, will be the S&P 500 VIX. So the VIX is the volatility index. It kind of encompasses, it is a function of many of the put options. So generally, when we talk about markets being bearish, we see a lot of them, we see a lot of volatility in the put options market. So that generally leads to a jump in terms of the VIX index. So when we look at the VIX, the general tendency is that we look at the 20 level. This is more of a textbook kind of a reading. The 20 level kind of marks a divide between more stable periods versus a more volatile period. So if it's above 20, it means that we are heading towards a potentially higher risk, more volatile risk environment. If it's below 20, it means that things are calm. We could potentially be looking at a more risk-on environment. So looking at the chart itself, you'll notice that in 2023, we have been trending below 20. There have actually been multiple attempts to move back above the 20 line, but you can see that those have actually failed. Those are actually failed attempts. So it translates that we are still on this risk-on environment. And we talk about risk-on environment, it means the indices on an upward bias. So this can help you to actually form your own, to sort of support your trade decisions. Of course, when you look at other indicators, we have the CFTC, that is where the futures positioning is. We also have the CNN Fear and Greed Index. That is easily, you can just Google it and then you can see that Fear and Greed Index. So those will give you a gauge of where the sentiments are. For example, recently when we look at the Fear and Greed Index, you will see that it's actually heading above 75, which means that we are trending in an extreme greed territory. And whenever you trace back towards the past 2 years, whenever the Fear and Greed Index moves towards this extreme greed territory, there is somewhat of a short-term retracement. And this time around, it seems that it has also sort of played out with a near-term retracement as well, because it just means that previous bullish positioning has been overcrowded. So when it is in that sense, you want to ride the trend, sure, no problem, but wait for a retracement, because the risk of a retracement is very high, the trade is very overcrowded, sentiments are very extremely greedy in that sense. So you wouldn't, like I mentioned, you wouldn't want to jump in front of the train right there and then. Wait for a retracement, continue to buy the dip and ride the trend itself. Other form of investors' sentiment positioning, I think I borrowed one from TD Ameritrade. They actually measure how their investors are sort of positioned. These are the retail side of things. So generally, we wouldn't want to lean towards retail positioning. We want to lean towards the bigger players, such as the institution. So how you read the IMX, the Investor Movement Index, is when things are sort of bottoming out, like we have seen in October or September-October period last year. That is where it suggests that many of the retails are actually being flushed out, and that is the time where you may want to jump in. So it seems that it has played out really well. You look at the recent bottoming out is around the September-October period. That is where the S&P 500 has also found its near-term bottom. And thereafter, we are seeing this very strong rebound. So it just means previously, retails are sort of flushed out from the COVID-19 boom. And thereafter, sentiments are extremely bearish on the retail side. And that is where things are poised for a rebound. So that is how you look at it. You can look at it from extreme form of levels. So of course, the next thing, hopefully we'll be able to see a move towards its previous peak. So it means that the retail side are being extremely bullish, and that is where you should be cautious, and things could be due for a downturn. Okay, the next thing will be the NAIM number. So this sort of show you where the investment managers in the US are. So it comprises of a basket of investment managers. So they'll ask them, how are you positioned in terms of your equity exposure, and then they'll give a reading, and then they'll average it out to give that number itself. So, but sad to say, how we look at this indicator from my point of view is actually a contrarian one. Generally, when things are on its high side, on an extreme bullish side of things, that is where you need to be cautious. But also we can also read it based on it's really subjective. So previously how I read it was during the COVID-19 bounce, when the NAIM number sort of dipped below the 60 level. That is where things could see a short-term rebound. And it has been playing really out well during the COVID-19 period. But now we are heading towards a different economic environment where the Fed is tightening. So that wasn't playing out well because we are heading towards, the overall strong bearish market that we have seen over the past 1 year. So how you read it is really subjective, but really take note of those extreme readings. That is where you have to be really careful, because things could be poised for a reversal. So those that I share with you, all these indicators are sort of easily available. You can really just Google it, look at it. Some of them are updated every week, quite frequent. So it really gives you a good idea of where sentiments are at the moment. Okay, some other ones that I'm going to show you probably may be a little bit, need a little bit more work from you. So all these are also easily Googleable, but they doesn't plot into a chart for you, as nicely as what you have seen here. So some, they give you the absolute reading. You may want to, take the effort to really plot it into a chart to give you a better picture. For example, the AAII US net investor sentiment. So it measures how many percent of investors are bullish, how many percent are bearish. Generally, we can take the difference between the bullish and the bearish to give us a gauge of where sentiment actually is. So when you reach extreme level, or sometimes we look at crossover. Crossover meaning we have this zero line there. Crossover means that if you are to cross from negative, which means bearishness, towards a positive reading, things could be sort of poised for a rebound. Likewise, for the put to call ratio, generally some people look at it as a reading of 1. Some people look at the level. Others look at extreme levels, such as extreme tops or extreme bottom, to indicate that markets are extremely bullish, extremely bearish. That is where things are poised for a correction. So these are actually how you can actually make use of some of these to form a picture of where the overall market sentiments is. Okay, just to introduce to you our own in-house sentiment indicator, we actually have this IG Client Sentiment Index. So it does show you, we have a huge pool of clients, very strong, very robust. So we use this to actually gauge how our clients are positioned in. So sad to say, they are traditionally looked upon as a contrarian indicator. The IG Client Sentiment is a contrarian form of indicator. But I would say, based on what I have observed over the past few years, sometimes it doesn't necessarily be contrarian. Okay, so in a way, when you look at it, you have to look at the trend. You have to measure whether the contrarian side of things has really worked out over the past 1 to 2 years. If it does, then there's a higher tendency that it can be used as a contrarian indicator. But sometimes when I look, it does suggest that the retail client positioning is right. So that is where you wouldn't want to tap on it as an indicator to form your view. Yeah, but that's just to share. You can easily search for it. We do have the IG Client Sentiment across many different assets, such as the S&P 500, the Dow Jones, which what we call it the Wall Street, or even many of the FX pair, gold and crude oil as well. So this is where you can also get an idea of where the overall sentiment is. Okay, next I'll move on to FX. For those who are interested in trading FX, likewise, we have the fundamental aspect, the technical aspect, and the sentiments aspect as well. So for the fundamental side of things, when we look at FX pair, I think it's really the difference in the policy. We said it as the policy divergence. For example, if you look at the dollar yen, we will look at the policy divergence between the Fed and the Bank of Japan. How hawkish or how dovish one is as relative to the other. So for now, if the Fed, the current situation, the Fed is being still maintaining its hawkishness, whereas the Bank of Japan is still maintaining its dovishness. So there is this policy divergence, and that kind of propel the dollar yen to its multi-month high, as you can see based on the chart on the recent movement for the dollar yen. So I think this whole policy divergence does play a part. And how do we look at it? We look at it on what market are pricing, what markets are deeming in terms of our interest rate expectations. So just to share, you can also try to find how markets are pricing in terms of the US. So probably this chart is a bit outdated, but just to give you an idea of where things are. So for example, in this case, where the US interest rate expectations are for just minor tweak in a rate hike, thereafter we are moving to a rate cut, as compared to the Euro area, where multiple rate hikes are still being priced. So in this case, it suggests that the Euro area seems the ECB has a higher probability of potentially being more hawkish than the US Fed itself. So that is where you can potentially see some upward trend in the euro dollar. Okay, this one is probably a byproduct of the policy divergence story. That is where the bond yields come into play. So likewise, bring your attention back towards the dollar yen. You can see that the bond yield differentials has actually been a very a close relationship with the pair itself. So if you want to confirm, okay, when you see that the dollar yen has a breakout, you may want to cross-reference to the bond yield differentials and see whether there is a somewhat of a confirmation, a breakout in that area as well to sort of confirm your trade. Okay, moving on, this is what we call the Big Mac Index. So we know that stocks have your PE ratio, have your PB ratio to give you an idea of how undervalued or how overvalued a stock is compared to historical, compared to the industry average. For currency, for Forex, we have the Big Mac Index. So you can look this up. Generally, when it's below zero, this is pegged to the US dollar. So for example, if it's below zero, it means that a currency is actually being undervalued compared to the US dollar. Whereas if it's above zero, you can conclude that a currency is actually being overvalued as compared to the US dollar. But the catch is that, as with all valuation, you wouldn't know when things will actually moderate. So you know that a stock is undervalued, for example, but how long do you actually have to hold that stock to actually wait for its valuation to catch up to a more fair value? You wouldn't know. It could take months, it could take years. Likewise, in this sense, it does give you an idea of how a currency is being undervalued or overvalued, but it doesn't really tell you how long it could take for it to actually revert to a more fair value. So you could potentially end up holding an undervalued currency pair against the US dollar and for months, and it didn't materialize. So that is just one catch there, but it does give you an idea of where the state is at the moment. Okay, of course, we have to move on to technical as well. I'll just bring to the US dollar. Same thing, currency, the technical side of things tends to hold a greater weight, I would say. So if you are strong in TA, that is where you excel in terms of the Forex market. For example, in this case, likewise, we look at weekly, we look at daily. In this case, for the US dollar, same thing, I like to use the Ichimoku Cloud, RSI, MACD, trend lines, moving average as well. Okay, likewise, weekly, like I mentioned, the weekly chart and the daily chart has to sort of find alignment. So for example, in this case, the Aussie dollar, okay, it does suggest that the cloud resistance seems to have a very significant role. The past 3 interactions actually failed to play out. So it just means that on the weekly side of things, we got to see it move above this cloud resistance to provide some conviction that the longer term trend is with us. Thereafter, then you can zoom into the daily chart to find some of the bullish setup to reinforce your decision to go long. Okay, for currency, there's also the sentiments side of things. So there's also the investors positioning side of things. So one key thing that I look out for is, same thing, this is from the CSTC data. It shows you how the large speculators, namely the hedge funds, how are they positioned in terms of their US dollar positioning against other currency. So from there you will want to find somewhat of a trend, somewhat of an indication. So for example, in this case, when we look at the US dollar aggregate positioning and the US dollar index, one of the indication that you can potentially single out is that whenever this aggregate positioning moves from a net short territory to a net long territory, meaning that many of these hedge funds are pairing their net short, they are switching to net long, it tends to coincide with some of the near-term bottom for the US dollar index as well. So next time, in a way, you can use this as a decision-making indicator. When you revert back to a net long position, that is where things could potentially find a near-term bottom for the US dollar index. So this is how you actually, how you can play around and look for patterns or look for indications to sort of reinforce your decision. Okay, we also have the sentiments in terms of client positioning from the IG Client Sentiment Index. So you can look this up as well. So it does shows some of how our clients are positioned. And it is looked upon as a contrarian indicator. So in this case, based on this client positioning for the dollar yen, when the retail are sort of holding, they are holding very low percentage of a net long, it does suggest that, it is a contrarian indicator. That means that it could potentially find a greater upside. Okay, now I'll move on to gold, the more popular commodities. Likewise, if you look at gold prices, there are also a few factors that you may want to take note of. Of course, for gold prices, you will see that it tends to correlate very closely or inversely with the US real interest rate. Okay, so what is the US real interest rate? So the US real interest rate is your US 10-year bond yields, okay, but it minus off the inflation expectation aspect. Okay, so it is your nominal bond yields minus what markets are expecting in terms of inflation. So that is how you get your real interest rate. So the general tendency is that when you have a negative or when you have a declining real interest rate, it does means based on that formula itself, it does means that your inflation percentage is potentially outgrowing your interest rate rise, and that is where and that explains why your real interest rate is declining. And in that sense, gold being a non-yielding asset could see some traction. So that could be one explanation for why it could have an inverse relationship. So of course, if you want to tap on the nominal bond yields, that is fair as well, but it doesn't give as clear a picture. So generally, you look at the US real interest rate in that sense. Okay, another thing that affects gold prices, of course, will be the US dollar. Why? Because gold prices are denominated in US dollar. So for example, we want to buy gold, but if the US dollar is appreciating much more as compared to the Sing dollar, it just means that we have to fork out more Sing dollars to buy that same amount of gold. So some people may hold back. That is why when we see a US dollar increase, there could be lesser traction for gold. But on the other hand, if you were to see US dollar decline, means that we can fork out less Sing dollars to exchange that same amount of gold, and that causes increased traction. So likewise, again, another inverse correlation that you can look out for. One will be the real interest rate, the other will be the US dollar for gold prices. Okay, another fundamental aspect that you can apply not just to gold prices, but also to all other asset class, that will be your seasonality. So what is seasonality? So seasonality means that you take the average performance over the past 10 years or even over the past 20, 30 years, and then you see whether there is any trend being formed, and you make a decision based on that. So for example, this is the seasonality for gold prices over the past 10 years. And you can see that over the past 10 years, something that will catch your eye will be the month of September, where you can see that out of the past 10 years for gold prices, in the month of September, there's only 1 year where gold prices turn in positive. There are 9 months where gold prices turn in negative. So using it as a data, you will think that, when we are heading towards September, based on seasonality, it does seem that gold could potentially have somewhat of a headwind. So that is where you may want to potentially, sort of pare down on your gold exposure, or you sort of hold more gold hedges, hold more, or even, go short on gold prices itself. So this is how you tap on seasonality to help you. And on the other hand, if you look at the month of January, I think that catch my eye as well. January, the positive percentage relatively high out of 10 years, 7 years in the green. Likewise, for December, same thing. Out of 10 years, 7 years in the green as well. So something to look out for when you look at seasonality. Of course, you can apply it to the S&P 500 as well. You can apply it to other FX pair as well. So this is how you actually tap on the seasonality trend. Technicals, I think it's kind of subjective. Everyone have their own technical setup. Everyone look at different technical indicators, but just to highlight, the technicals can also quite significant for gold prices. So for example, in this case, we want to follow the trend. So, we have a very nicely upward drawn trend line here, a very nicely upward sloping moving average, Ichimoku cloud. But after that, there was actually a break in around the June period. You can see that the support confluence doesn't hold, and that is where there's potentially a trend change. So that is where you could, pair down on your long, switch to a short potentially. Okay, on the sentiment side of things, there's also the investors positioning from the CFTC. So it's actually released every Friday, but it's kind of a lagging data. So it will release every Friday, but it shows you a snapshot of the money managers positioning on Tuesday. So there is somewhat of a few days lag, but nevertheless, it does provide a very good picture of where the money managers are positioned. So you can see that in the late 2022 till 2023, there's actually a very strong surge in this. So many money managers are building up net long in terms of gold prices, and that also explains that strong rally that we have seen in gold prices previously. So you can look at it in terms of a confirmation kind of indicator, whereby, if you use your fundamental, your technical to gauge that gold prices are moving up, you can use this CFTC data to sort of confirm that, the money managers are trading along in the same direction as you. That provides somewhat of a more conviction. But of course, some things to take note of as well is where it reaches some of these significant peak. It just means that, when money managers are holding a very significant net long positioning, it could point towards some near-term unwinding. So that could also be how you can use this data. We also have IG client sentiment for gold. You can also use this to gauge how our retail investors are positioned. For gold prices, I wouldn't say it worked really well. I would say our IG client sentiments could work better for the US indices, for the FX. Gold-wise, there are some instances where it doesn't play out as well. So personally, I think you can actually sort of just take it as a reinforcing factor rather than a decision-making factor. You can turn towards others such as the money managers positioning to sort of give you a better idea. Okay, last part, Brent crude. So what actually affects oil prices? I think we cannot escape the US dollar as well, because Brent crude prices tends to be denominated in US dollar. So likewise, when US dollar fall, buying that same amount of Brent crude, it is actually relatively cheaper, so it could translate to increased demand. So you can see that generally there is an inverse relationship, but it doesn't play out all the time. For example, you see the post-COVID-19 period, the 2020 year onwards, you can see that it tends to go hand in hand. And why is because of fundamental aspects. So we are coming out of a COVID-19 boom, and we are seeing a very strong economic conditions. And when you look at the US dollar, we only see upside in two scenarios. Okay, one is when the economic conditions are very, very strong. The other is when the US economic conditions are very, very weak. So that explains, the significant upside in the US dollar. So you can actually Google it. It's called the US dollar smile theory. So they call it a smile, S-M-I-L-E, smile theory. It tells you when we can actually see a very strong upside in the US dollar. So only in these two situations, one is where economic conditions are very strong, one is when economic conditions are very weak. So post-COVID-19 recovery, we are coming off a very, very strong economic recovery. The US dollar is ramping up. Likewise, for oil prices, we are also seeing a lot of reopening that also translates to a very strong demand for oil prices. So you can see that it doesn't necessarily correlate 100% of the time. When things change, when economic conditions change, that is where there are times where it could take on the same side. And that is why, we sort of have to balance it out with many of the fundamental economic factors as well. Okay, other than that, when we talk about oil prices, I mean, the supply outlook is in the picture, the demand outlook is in the picture. So some of the economic data that you can track for oil prices, I think every week we will have the total change in the crude oil inventories. So generally the tendency that when we look at a multiple weeks of a negative reading, meaning that we are seeing a continued drain in terms of the crude oil inventories, that could point towards a tighter supply outlook. Yeah. And on the other hand, there's also the US 48 oil production. So it measures the oil production in 48 states in the US. Generally, when things are being lackluster on a downward trend, it means that the US are not producing as much crude oil, so that adds on to that whole tighter supply scenario as well. So some economic indicators, some economic data that you can watch. And of course, the technical side of things, we cannot escape from it. How we look at oil prices now, just to give you my view, oil prices now trading in a consolidation pattern. And when we look at this consolidation pattern, a breakout will be what we are looking for, whether to the upside or to the downside, to show the buyers or sellers are taking greater control. So technicals, kind of a ranging move for the US, for the Brent crude oil. And last but not least, we also have the CFTC data for oil positioning. It also shows you where all the large speculators are positioned. So you can see over the past 5 years, there tends to be sort of going hand in hand. When we see a building net long positioning, it tends to translate to increased upside for the oil prices. But one key thing to note also is that it tends to come with a lag. I mean, the CFTC data comes with a few days lag, so it can only sort of serve as a confirmation indicator. So that is something that you may want to take note of. Okay, we also have IG client sentiment for oil. Oil, I would say the positioning may work better than gold. So how we make use of this is where we see, for example, in this chart, okay, you can see that the 80 level seems to mark some of the significant bottom in terms of oil prices. So 80 just means that, many of our retail traders there's like, 80% of our clients are net long in terms of oil. It points towards somewhat that, many of the retails are sort of jumping in. And that is where, we can look at it from a contrarian side of indicator. Okay, so with that, I come to the end of my presentation. So just to round it off, when we look at different asset class, the 3 components that we look out for is in terms of the fundamental analysis. And different asset class, you can potentially look at different things. And we have the technical side of things. And last but not least, we have the sentiment side of things. So how you really look at it, I would say you need to have a balance. Okay, you cannot solely depend on just the fundamental side of things or just the sentiment side of things. You can really give all of this can really give you a better picture. So you make use of all this data, form a very concrete picture, and then you find a reinforcement. So for example, you have very strong conviction that economic rebound is on the way. You look towards the technical side of things. Is it showing somewhat of a reversal pattern? Because the answer is yes, then both sides are aligned. And then you look towards the sentiments side of things, and then what you are looking for will whether are sentiments being extremely bearish. Okay, because if things are extremely bearish, there's an overcrowded trade there, that provides somewhat of a conviction that things could start to turn. So when all these three areas are sort of being aligned, that is where you can really find the conviction to go into a net long position. So this is just an example of how you can make use of all this. Okay, so with that, I'll look at the question. If you have any question, please feel free to type in the chat. I saw one that says, where can I find the US leading index and US coincident index? Is it available for all countries or just US? Okay, for this is actually just for US. I think you can actually Google it. You can actually Google it and then you can find. I don't have the exact website with me at the moment. Yeah, but definitely, if you cannot, just feel free to reach out and then I can help to find it for you. But sad to say so, it's only available in the US. Yeah. Okay, next one will be, where can we find the data for AII-US? Yeah, all these are actually Googleable as well. So you can Google the AII-US net investor sentiment. But the catch is that, as I mentioned, the catch is that they give you an absolute reading every week in terms of the percentage of traders in net long, percentage of traders in bullish and bearish side. So you got to download the data, plot it out, and then what you do is you use the data, you plot against the S&P 500, and then you see whether there's any pattern, whether there's any trend, whether when investors are being extremely bearish, whether does it coincide with the lows for the S&P 500. And if it does, that provides one added conviction for you that the next time where things are overly bearish, you could potentially look for a reversal in the S&P 500. So that is where you can actually make use of this data. Likewise, for the put call ratio, I think you can Google as well. So same thing, what I do, take that put call ratio, plot with the index, find a pattern. Okay, if you cannot find a pattern, you can just put it one side because it doesn't work, right? It doesn't serve as much of a use. And when you find a pattern, not just probably one coincidence or two coincidences, you want to look for a more sustaining form of thing. So for example, when I show you the US dollar against the hedge fund positioning, the CFTC one, if you recall, there are generally many instances where it reverts to a net long and it marks a near-term bottom for the US dollar. So that provides more conviction rather than just looking for one or two form of a coincidence. So that is how you can actually use this to form your conviction as well. Okay, about breaking news in oil cut from Saudi Arabia, how should be the action? Okay, so I think this is more of a market question. Okay, recently, the Saudi Arabia mentioned that they will be cutting their oil supply. How should be the action? If you were to observe, this is actually the second time where we are talking about oil cuts. So the first time, actually, the OPEC Plus has guided for a oil production cut earlier as well. If you observe the oil prices, things have been, there was a few days of a rebound, but things didn't manage to sustain. Thereafter, the oil prices have, moved back towards its low. Same thing for this Saudi Arabia case. After it was announced, a few hours later, there was a strong rebound in oil prices, but it didn't manage to sustain. Very quickly, many traders are selling the bounce. Many of the gains are pared back. Now, oil prices are actually moving back towards its 2023 bottom. So what we can conclude from this is that, yes, even though a tighter supply outlook can have a positive impact on oil prices, but we need to think of the demand side as well. So you can see that oil prices, it doesn't seem to be reacting as much to that tighter supply kind of a tailwind. It seems that it's reacting more towards the demand side of things. So demand side of things for oil, you got to look at China, whether we are able to see a stronger recovery in China. You got to look at many of the global economic conditions, such as in the US, in the Eurozone, are the economic conditions holding up, or whether, there's downside risk being presented. So for now, China's recovery is still being kind of lackluster. And one can definitely say that there is still downside risk to to US economic conditions as seen from the leading indicator. So that doesn't provide, that is why investors are still sort of holding back for oil prices. Okay, which time frame chart good to use? I think it really depends on you. I mean, if you are a very short-term trader, I know traders that look at a 4-hour, 1-hour chart, and then they trade for that night itself. It's really up to you how you can really sit in front of the screen and stare at the candlestick being formed, right? So for me, what I do, my own personal one, I look at daily and weekly. I do not want to, trade very short time frame. So I look at the daily chart first. Okay, if things are going sort of an upward bias situation, then I zoom up towards a larger time frame to see whether the weekly chart kind of coincides with everything. Because when you go into, for me, I believe that when you go into a position based on the daily chart, you could potentially hold it for weeks. Yeah, it doesn't mean that unless you are going for a very short-term kind of punt, that kind of thing. Fair enough. But for me, I believe that there's always a risk that you have to hold it for weeks. And that is where I look at the weekly chart to sort of give me some conviction that things are also on an upward trend along with the daily trend, so that, I can be more confident in my positioning. Okay, any other questions? Yeah, if not, I'll pass on the time back to Ethan. Yeah.
Okay, thank you, Jun Rong. Okay, and I think a lot of questions that we have also was on this session on the recording, if the recording is available. So yes, we will actually upload the recording on both our YouTube channel and also on our IG Academy. So if you are new to IG, again, just Google for this IG Webinar Library Singapore, or just Google for IG Singapore in YouTube. Okay, so we'll upload this recording in both our Academy, IG Academy, and in our YouTube channel as well, probably in about a week or so. So just look out for that. Okay, if not, I just wanted to bring your attention again to the feedback form. I think I've left it here for the past, 5 minutes or so. So I just wanted to ask for a very small favor for the audience to actually scan this QR code. And if you think this session is useful for you and these are content that you actually like, please just let us know. Or if you think that there's any improvement points or any particular segment that we did not cover today, just leave it in the feedback form as well, so we know where we can improve too. Okay, if not, once again, thanks Jun Rong for sharing his insights today. And of course, I want to thank the viewers as well for staying with us throughout this 1-hour session. Okay, if not, then we have come to the end of today's session. I just wanted to wish everyone to have a great evening and have a great end to your night. Okay, thanks and goodbye.